Hello, I'm Ivan Gruhl, Co-Chief Investment Officer with Avantax. Today we'll provide a market update for May. We'll start with a recap of returns for April and then shift to our key themes, interest rates and bonds and opportunities going forward in stocks around the globe. Stocks finished the month of April mostly lower, following a strong start to the year. For the month, the S&P 500 was lower by about 4%, while the Russell 2000 fell 7%. On the international front, the MSCI EAFE index fell about 2.3%, while emerging markets saw positive returns to the tune of about 1% thanks to a strong month for stocks in China. Year-to-date, the S&P 500 index remains firmly in positive territory, higher by more than 6% on the year. Higher interest rates have weighed on small-cap stocks recently, and the Russell 2000 index is lower by about 2% year-to-date, despite a strong start to the year. International developed and emerging market stocks both remain in positive territory, higher by about 3%. Shifting to bonds, interest rates moved notably higher during the month of April, translating into negative returns for both taxable and municipal bond investors. For the month, taxable bonds lost about 2.5% in total return, while municipal bonds were lower by about 1%. For the year-to-date, municipal bonds continue to outperform taxable bonds, but both indices remain in negative territory, with the taxable index lower by about 3% and the municipal index lower by about 1.5%. Turning to inflation and interest rates, we have seen some stalling in the path to disinflation in recent months, which has led to concerns that inflation may struggle to reach the Fed's 2% target. However, decreases in shelter and auto insurance prices, stable supply chains, and slowing wage growth should allow inflation to continue its slow descent to 2%. Meanwhile, resilient economic growth has diminished expectations for rate cuts, with this chart showing futures data that predicts just one rate cut for the year 2024. With market expectations and the Federal Reserve now in sync, interest rate volatility should decline. Bonds have struggled in the early stages of 2024, but we continue to believe that this is a good entry point for fixed income to play its role in providing income and diversification in portfolios while providing upside price appreciation as rates eventually decline. As this chart shows, the total return impact is significant for a fall in interest rates as returns are augmented by significant yields across the curve. Turning to stocks, in the U.S., earnings and profit margins have rebounded from a weak year in 2023, and we believe profits could experience healthy growth in 2024. As we have previously noted, the Magnificent Seven drove the lion's share of earnings growth last year, but we now see broadening profit leadership that supports a diversified approach to opportunities in other parts of the market. Away from the U.S., as this chart shows, international markets look favorably priced in both absolute terms and relative to history. Attractive valuations, combined with improving earnings expectations and margins on the international front, presents a timely opportunity for investors to diversify abroad. Overall, even with a slowing economy, we see opportunities in bonds as interest rate volatility diminishes, earnings and profits are rebounding, and international stock valuations are attractive as we move toward the second half of 2024. So that's what we have for this month. Thank you for watching, and have a great day.